Imagine this for a second. Markets are closed, the weekend is quiet, and suddenly breaking news appears. Explosions in Tehran. But this time, the target isn't a missile base or a military command center. It's oil infrastructure. Storage depots burning, flames rising over the capital. And while the world watches the headlines, another story is quietly unfolding inside the financial system. Gold and silver are sitting at critical levels. Oil just surged in one of the biggest single-day moves in years. Meanwhile, physical silver inventories are draining faster than anyone expected. By the time markets reopen Monday morning, the entire financial landscape could look very different. Most people think markets move because of simple reasons. Good news pushes prices up, bad news pushes them down. But the reality is much more complicated. Financial markets are deeply connected systems where events in geopolitics, commodities, and monetary policy collide all at once. Right now, several pressure points are building simultaneously, and the average investor barely notices them. First, there's the issue of physical metal availability, particularly silver. Exchanges that are supposed to supply real metal are watching their inventories slowly drain. The amount of silver that can actually be delivered to buyers is shrinking. At the same time, the number of paper contracts representing silver keeps growing. This creates a dangerous imbalance. Imagine a warehouse that holds 80 million ounces of silver while traders hold paper contracts claiming almost 300 million ounces. As long as most traders settle their contracts in cash, the system functions. But if too many people suddenly demand the physical metal, the math simply stops working. Second, there is the growing tension in the energy market. Oil prices have already been rising due to supply disruptions and geopolitical instability. Now, with infrastructure directly targeted in the conflict involving Iran, the situation becomes far more serious. Energy markets react quickly to risk because oil fuels nearly every part of the global economy. Higher oil prices ripple through everything: transportation costs, manufacturing expenses, food prices, and household budgets. Third, central banks are trapped in a difficult position. Inflation remains a persistent threat, yet economic growth is fragile. If inflation surges again due to energy shocks, central banks may be forced to keep interest rates high even while economies weaken. This combination has a name: stagflation. Stagflation is rare, but when it appears, it changes the behavior of investors everywhere. Stocks struggle, currencies fluctuate, and hard assets like gold and silver suddenly become extremely attractive. The problem is that these forces are all developing at the same time: shrinking silver inventories, escalating geopolitical tension, rising oil prices, and a monetary system already under strain. Individually, each factor would be important. Together, they create a situation the financial system has not faced in many years, and that's why the next few market sessions could become extremely important. To understand why this moment matters, we need to look at three different stories unfolding across the world. At first glance, they appear unrelated. One story is happening inside the vaults of commodity exchanges, another is unfolding in China's trading system. The third is taking place on the geopolitical stage in the Middle East. But when you examine the details carefully, you begin to see the connections. Let's start with the metal markets. Silver has always been a unique commodity. It's both an investment asset and an industrial material. It's used in solar panels, electronics, electric vehicles, and advanced manufacturing. That means demand comes from two directions at once: investors looking for protection and industries that physically need the metal to operate. Recently, the amount of silver available for delivery in major exchanges has been shrinking. At the same time, the number of paper claims representing silver remains extremely large. This creates a situation where the paper market grows faster than the supply of the real metal. Next, look at what's happening in China. The Shanghai Futures market recently took action against several groups of traders who were opening large new positions in silver. Authorities temporarily restricted their activity to prevent excessive speculation. That kind of intervention is unusual, and it suggests regulators are trying to control volatility in the market. Finally, consider the geopolitical environment. For months, the conflict involving Iran has mostly focused on military facilities, but targeting energy infrastructure changes the entire economic equation. Oil production, storage, and shipping routes suddenly become potential flashpoints. When oil markets sense supply risk, prices move quickly. Now think about how these three stories connect: silver supply tightening, trading restrictions in a major metals market, and rising energy prices from geopolitical escalation. Individually, they may seem like separate developments, but together they point toward a larger shift forming inside the global financial system. And that shift could become visible the moment markets open again. To really understand why analysts are paying so much attention to the silver market right now, we need to step back and look at how this system actually works. Because what most people imagine when they hear the words silver market is very different from reality. Most people picture something simple. Buyers purchase silver, sellers provide it, and the exchange acts like a marketplace connecting the two. But modern commodity markets are not that straightforward. In fact, most of the trading that happens in precious metals does not involve physical metal at all. Instead, it happens through something called futures contracts. A futures contract is essentially a promise. It allows traders to agree on a price today for silver that will be delivered sometime in the future. These contracts are bought and sold thousands of times every day by hedge funds, banks, institutions, and individual traders. In theory, when a contract reaches its expiration date, the buyer can request delivery of the actual silver. The exchange is supposed to make sure that metal exists in its vaults so that delivery can happen smoothly. But here's the detail that most people never hear about. The majority of futures contracts never lead to delivery. Most traders are simply speculating on price movements. They buy contracts hoping prices will rise, or sell contracts expecting prices to fall. Before the contract expires, they close their position or roll it forward into another contract. Because of this behavior, the futures market has gradually become much larger than the physical market. Imagine a warehouse with a certain amount of silver sitting inside. Now imagine thousands of traders holding contracts that represent ownership of silver that may or may not ever leave that warehouse. As long as only a small percentage of those traders request physical delivery, everything works fine. The system keeps moving, prices fluctuate, and the exchange maintains the illusion of balance. But probably this is exactly the situation that analysts are beginning to notice today. Over the past several weeks, the amount of silver registered for delivery in major exchange vaults has been declining. Every time metal leaves the vault system, the amount available to satisfy delivery requests becomes smaller. Meanwhile, the number of outstanding contracts representing silver remains very large. This creates an imbalance between paper demand and physical supply. To understand why that matters, think about it like a bank. Banks do not keep every dollar deposited by customers sitting inside their vaults. Instead, they operate on a system of fractional reserves, meaning only a portion of deposits are held as cash while the rest is loaned out. That system works perfectly as long as customers trust the bank and only a few people withdraw money at the same time. But if everyone tries to withdraw their cash simultaneously, the bank simply cannot provide it. The silver market operates in a surprisingly similar way. As long as traders remain comfortable settling their contracts in cash, the gap between paper contracts and physical metal stays hidden. But if confidence changes and more participants begin requesting actual metal delivery, that gap suddenly becomes very visible. Now add another layer to the story. Global demand. Silver is not just an investment asset like gold, it is also an industrial metal that plays a critical role in modern technology. It is used in solar panels, electronics, medical equipment, electric vehicles, and countless other advanced manufacturing processes. This means demand for silver does not only come from investors seeking safety, it also comes from industries that physically need the metal to produce goods. As renewable energy expands around the world, silver demand from solar manufacturing alone has increased significantly. Each solar panel requires small amounts of silver to function efficiently. When millions of panels are produced every year, that small amount quickly turns into a massive demand for the metal. Countries like China and India have become particularly important in this demand story. China, in particular, is the largest manufacturer of solar technology and one of the biggest consumers of industrial metals in the world. Its factories, electronics companies, and energy sector require enormous quantities of raw materials. This means silver flowing into Asia often disappears into industrial supply chains rather than returning to the global trading system. At the same time, investment demand for precious metals can surge whenever economic uncertainty rises. During periods of geopolitical tension, inflation fears, or currency instability, investors often move money into assets that have historically preserved value. Gold usually receives the most attention, but silver often follows the same trend because it shares many of the same characteristics. The difference is that silver's market is much smaller than gold's. That means price movements can sometimes be faster and more volatile. Now combine all of these elements together. A futures market dominated by paper contracts, physical inventories that fluctuate as metal moves between vaults and industrial users, growing demand from technology and renewable energy industries, and investors watching global instability with increasing concern. Each of these factors interacts with the others in ways that are not always obvious. Sometimes the system absorbs these pressures quietly. Prices move slowly, markets adjust, and everything appears stable. But occasionally the pressures begin building at the same time. When that happens, analysts start paying very close attention. Because history shows that commodity markets can remain calm for long periods, until suddenly they are not. And when the balance between supply, demand, and market confidence begins to shift, the effects can ripple across the entire financial system. That is why the current moment in the silver market has captured so much attention from analysts, traders, and investors around the world, not because of one single event, but because several important forces appear to be moving in the same direction at the same time. When you step back and look at all the pieces together, a much clearer picture starts to form. None of the individual developments we discussed would necessarily be shocking on their own. Markets deal with supply changes, regulatory actions, and geopolitical tensions all the time. But when several of these forces begin moving in the same direction simultaneously, the situation becomes far more significant. Right now, the silver market is facing a structural imbalance that analysts have been quietly watching for months. The number of paper contracts representing silver is extremely large compared to the amount of physical metal that is actually ready for delivery. As long as the majority of traders treat futures contracts purely as financial instruments, this imbalance remains manageable. But the system relies heavily on one key assumption, that most participants will never request the physical metal behind those contracts. If that assumption holds, the market continues functioning smoothly. Traders roll contracts forward, settle positions in cash, and the underlying supply of metal remains mostly untouched. However, if market sentiment changes and more participants begin requesting delivery, the difference between paper claims and real inventory suddenly becomes impossible to ignore. This is where the tightening supply of physical silver becomes important. Declining inventories inside major exchange vaults suggest that the amount of metal available for delivery is gradually shrinking. Each withdrawal removes another portion of supply from the system, reducing the buffer that normally protects the market from stress. At the same time, actions taken in Asian trading markets hint that regulators are closely monitoring trading activity. When authorities restrict aggressive position building or suspend certain accounts, it usually indicates concern about excessive speculation or potential instability. These kinds of interventions are designed to slow things down before volatility spirals out of control. Now add the energy situation into the equation. Energy markets are one of the most powerful drivers of inflation because oil and natural gas affect nearly every sector of the global economy. Transportation, manufacturing, agriculture, and even electricity generation all depend on stable energy supplies. When geopolitical tensions threaten oil infrastructure or shipping routes, traders immediately begin pricing in the possibility of future shortages. Higher oil prices can quickly translate into rising costs for businesses and consumers. Over time, these higher costs spread through the economy, pushing inflation upward. This creates a difficult challenge for central banks. Normally, central banks fight inflation by raising interest rates. Higher rates slow down borrowing, spending, and economic growth, which helps reduce price pressure. But if economic growth is already weak, raising rates further can cause significant damage to the economy. This is the classic dilemma of stagflation, rising prices combined with slow economic growth. Historically, periods like this have been favorable for precious metals. Investors often turn toward assets like gold and silver because they are tangible stores of value that are not directly tied to government monetary policy. Another important factor is investor psychology. Financial markets are built on trust. Traders trust exchanges to operate fairly, investors trust contracts to represent real assets, and institutions rely on stable systems to manage global capital flows. When uncertainty increases, whether from geopolitical conflict, inflation concerns, or financial instability, investors often start looking for assets that feel more secure and tangible. That shift in perception can dramatically change demand patterns in commodity markets. None of these developments guarantee immediate price explosions in gold or silver. Markets rarely move in straight lines, and short-term volatility can push prices in either direction. But the broader conditions forming in the global economy are becoming increasingly unusual. Shrinking physical supply, regulatory intervention in key trading markets, and rising geopolitical tension that threatens global energy stability. When these forces appear together, they create an environment where precious metals suddenly move from being a quiet corner of the market to becoming a central focus for investors. And that is exactly why so many analysts are watching the current situation in the silver market so closely. Now I want to hear your perspective. Financial markets are full of opinions, predictions, and debates. But the most interesting insights often come from people who carefully study the data and connect different pieces of information. So think about the situation we just discussed. Silver inventories declining while paper contracts remain large. Regulatory actions affecting trading activity in major markets. Geopolitical developments that could reshape energy supply and inflation. Do you think these forces will push precious metals significantly higher? Or do you believe markets will absorb the shocks and continue moving within familiar ranges? Another key question is timing. Some investors believe major changes in commodity markets happen slowly over years. Others believe sudden catalysts, like geopolitical events or supply disruptions, can accelerate trends almost overnight. Which view do you agree with? And what do you think traders should be watching most closely in the coming days? Oil prices, currency movements, or the behavior of silver around major resistance levels? Drop your thoughts in the comments and share your analysis. Discussions like this help everyone better understand the complex forces shaping global markets. As we move into the next trading sessions, Several indicators will reveal how serious these developments truly are. First, watch the energy market. Oil prices often react immediately to geopolitical risk, and sustained increases can signal that traders expect supply disruptions to continue. Second, keep an eye on currency movements, particularly the strength of the US dollar. Precious metals frequently move in the opposite direction of the dollar, so shifts in currency sentiment can strongly influence gold and silver prices. Third, pay attention to silver's technical levels. Markets often pause or reverse at key resistance zones where buyers and sellers battle for control. If silver pushes decisively beyond those levels and holds the move, it could signal a shift in market sentiment. But perhaps the most important factor is the one investors rarely see: the physical flow of metal inside global vault systems. If inventories continue declining while demand remains strong, the pressure within the market gradually increases. And when pressure builds long enough inside any system, financial or physical, something eventually changes. That's why the coming weeks could be particularly important for anyone following precious metals. Because beneath the daily headlines and price charts, deeper forces are quietly building momentum. And when those forces finally reveal themselves in the market, the move rarely arrives quietly.